if you read an actual IRS versus cannabis court case, it's like reading a montage of disallowed positions if you look at the history and the archives of what has been substantiated in these courts and assessed and been made into applicable tax law. 280E originally was supposed to be seen as unconstitutional and trying to get cannabis out of it. IRS and tax courts determined that it is constitutional. 280E applies. Operating expenses were attempted to be deducted for various purposes. That didn't fly either. They said that, sorry, operating expenses can't be deducted, only cost of goods sold could be used to reduce taxable income. Only the portion of inventory that is sold could be taken as cost of goods sold. So no, you can't just buy inventory, leave it on the shelves, and then deduct it as cost of goods sold. It doesn't work. You have to actually sell the inventory before you can write it off, which created timing issues. It couldn't use maker's depreciation. So they said, sorry, you have to use GAAP straight line depreciation under generally accepted accounting principles. So cannabis has to follow GAAP accounting, can't follow some of the other accounting principles we would normally use in other businesses for ordinary tax purposes. And then they recently came out and they said non-deductible wages were not considered in QBI calculations. And since cannabis companies can't take any wages as deductions, they can only capitalize them in some cases and write them off as cost of goods sold once the inventory again is sold. It effectively means that there's no QBI to the extent of wages. So that was another disallowance of QBI. It's changed a lot of the tax plannings that we've had to do. Double taxation on management LLCs. Try to set up a non-plant touching entity. Substantial ownership is the same, economic incentives aligned. That entity becomes a plant touching entity, double taxation occurred. Disallowance of non-plant touching divisions without special circumstances. You can't just say that half the dispensary is used for non-plant touching retail products. It's part of the dispensary. It's all the same business, plant touching as well. And virtually every other position that you could think of has been disallowed and penalized in the IRS tax courts, and yet people still try to push the boundaries on their 280E tax returns. There's always a new trendy position running around. There's always a new one where somebody says, oh, the auditors let me get away with it, and everyone tries it, and it just ends up blowing up in everyone's face. So honestly, if you're doing your accounting right, the taxes shouldn't be that bad. Just my opinion.